Welcome to The Explainer. Today, we're diving into the two emotions that secretly run the entire stock market. Yep, good old fear and greed. You've probably heard this one before. It's that classic advice from the legend himself, Warren Buffett. And on the surface, it sounds so simple, right? Just buy when everyone else is freaking out and sell when they're all popping champagne. But here's the thing. Doing that, it fights against every single one of our deepest human instincts. So to really get why this is so tough, you've got to stop looking at the market as just a bunch of numbers and charts on a screen. Think of it more like a massive, worldwide emotional battlefield. Seriously. All right, let's get into it. We're talking about the two core emotions that have made and broken fortunes since, well, forever. And what's really cool is that we can actually see this emotional battle play out. People have created these tools that try to put a number on it all. They're tracking whether investors are in greed mode, just piling into stocks and driving prices up, or if they're in fear mode, panicking and selling off everything. You can literally watch the market's mood swing back and forth just like a pendulum. Okay, so we can see these massive mood swings, but why do they happen? What's the deep psychological force behind it all? Well, it turns out we're basically hardwired to follow the crowd. Yeah, there's a name for this in behavioral finance, herd mentality. It's this deep, built-in urge to just do what everyone else is doing. And, this isn't some new age internet thing. It's a survival instinct. For pretty much all of human history, sticking with the tribe meant you were safe. But when it comes to investing, that same instinct can be an absolute disaster. And today, that instinct gets cranked up to 11 by something we all know, FOMO, the fear of missing out. You see some stock just skyrocketing, and that little voice in your head starts screaming, "Get in now before it's too late." And that's when we toss all our own research out the window and end up buying right at the top. It's exactly this behavior that creates those giant market bubbles and makes crashes so much worse. And this really just nails the problem, doesn't it? When prices start swinging like crazy, our emotional brain completely takes over from our rational brain. Suddenly, really smart, logical people start doing things that make absolutely no sense. Okay, so if our brains are just wired this way, how in the world do guys like Buffett pull it off? How do they fight that urge and actually go against the crowd? Well, it starts with understanding another one of our brain's little quirks, something called loss aversion. Tons of research has shown this. The pain you feel from losing, say, $100, is way more intense, like twice as intense, as the good feeling you get from gaining $100. We are just fundamentally wired to avoid losses. And that, right there, that bias is exactly why it feels so right to sell when the market is crashing. Your brain is just screaming, "Make the pain stop." Even though selling is what locks in your loss and is probably the worst thing you can do for the long run. Buffett's whole strategy is built on recognizing that panic, both in other people and in himself, and then doing the exact opposite. So here's the key takeaway. The solution, the contrarian mindset, is to shift your focus entirely. Stop obsessing over the market's daily mood swings. Instead, you have to focus on the real, tangible value of the business you're looking at. Is it a good company? Does it make money? That's the stuff that actually matters. All right, so let's look at how these two different mindsets, following the herd or going against it, actually translate into investment strategies. And more importantly, what does the data say? It really comes down to two big ideas. You've got momentum investing, which is basically surfing the wave with the herd. You buy what's hot. And then you have contrarian investing, which is the total opposite. You're betting the herd is wrong, so you go searching for deals in the stuff that everyone else hates. So check this out. A really interesting 2025 review looked at 25 different studies on this and found something critical. Neither strategy is perfect all the time. But here's the real insight. They work best on different timelines because they're plugging into different parts of our psychology. Momentum investing can work great in the short term. Why? Because that herd mentality and FOMO create this powerful loop, right? Prices go up, which gets more people excited, who then buy more, pushing prices even higher. It can be a self-fulfilling prophecy for a while. But the contrarian strategy tends to win out over the long term because eventually reality has to set in. The stock price, driven by all that emotion, has to eventually come back to the actual value of the company. It's the herd's overreaction, both on the way up and on the way down, that creates these opportunities for patient investors. So what's the big takeaway here? It's not about just picking one strategy and calling it a day. It's about building a system, a framework for yourself, to manage your own psychology so you can make smarter decisions no matter what the crowd is up to.
And we can actually boil this down to a pretty simple 3-step checklist. Think of it as your guide to staying rational when everyone else is losing their minds. Okay, step 1. Before you do anything, take the market's temperature. Use a tool like that Fear and Greed Index to figure out, is everyone acting out of extreme fear or extreme greed? Just having that context can completely change your perspective. Step 2. This one's tough. You have to be really honest with yourself. Admit that you are just as vulnerable to these biases as anyone else. Ask yourself, am I feeling that FOMO creeping in? Am I about to sell just because I can't stand the pain of seeing my account go down? Sometimes just naming the emotion is enough to take away its power over you. And finally, step 3, bring it all back to the business itself. You need to anchor your decisions in reality, the reality of the company's health, not the crazy, chaotic noise of the daily stock price. Always come back to that one simple question. Is this a good company? And is the price I'm paying fair? Because at the end of the day, the market is always going to be driven by emotion. The question is, are you going to let it drive you too? Understanding these powerful forces, the fear, the greed, your own biases, that isn't just some academic exercise. It's the first and most important step toward actually taking control.